Hello, my future six-figure traders. If you repeat a lie often enough, people will start to believe it. As this saying goes, this also holds true in the trading community, where people repeatedly use terminology attached to auction market theory, ICT, smart money concepts, and so forth. In this video, I will show you the one and only concept you need to understand to become a successful trader and see behind the curtain and hack market microstructure. Before we're getting to the nitty-gritty of how you can hack market microstructure, stick around till the end of the video to get the details how you can enter the CEED Accelerator giveaway. First prize will be full course access, valued at $597. Second prize will get a 50% discount, and the third prize will be a 30% discount. So stick around till the end. It's much simpler than you probably think. The one and only key concept you need to fully understand to gain clarity, confidence, and consistency, and ultimately profitability in your trading is urgency, which I will illustrate here using what I call the urgency triangle. You may wonder now, why should I care about urgency and what does it really mean in the trading context? In simple terms, traders with high urgency will actively seek and consume liquidity using market orders, while low urgency traders wait for execution by predominantly using limit orders away from the prevailing market price. This applies to all markets and asset classes, no matter if you want to trade stocks, futures, or cryptos. The first group of traders in the urgency triangle are so-called informed traders, which are large institutions who try to minimize the market impact of their orders to achieve best execution. This group is primarily responsible for permanent or sticky price changes of an underlying asset. The second group of traders are defined as partially informed traders, which includes market makers, but also large prop trading desks, which are classified as aggressive HFTs. In terms of urgency, we focus on option market makers here because they generate urgent order flow from their hedging activities when they hedge their net gamma exposure. The third group of traders are opportunistic traders who have no private information on other traders' intentions and mostly generate order flow that is commonly referred to as noise in this context. Informed traders master intentions by slicing large meta orders into many smaller pieces or so-called child orders to also avoid detection by other trader groups. This relationship is illustrated by the square root law formula of market impact. Of course, this is an overly simplified formula, but it serves to show the main factors influencing market impact. Depending on the size of the order and the prevalent volatility in the underlying instrument, big institutions set the urgency level for the algorithmic order executions to either high, medium, or low, for example. This means that if competition for liquidity is deemed high, they need to step on the gas and use more market orders to get the order filled, depending on the relative size of the order compared to average daily trading volume. Market makers, on the other hand, constantly monitor whether they are providing liquidity to an informed trader using tools like VPIN, or volume synchronized probability of informed trading, because they want to avoid adverse selection as much as possible, which in a nutshell means providing liquidity at a loss to an informed trader. After detecting of what they deem toxic order flow, market makers adjust their regular liquidity provision and possibly increase hedging activities, while aggressive HFTs aim to trade in the direction of informed order flow. As the sophisticated, opportunistic traders that we are, and that you are to become, you can now use the same principles of detecting informed algorithmic order flow, by monitoring situation with above average daily volume, significant bid-ask delta imbalances or one-sided order flow, and periods of increased transaction speed. In essence, mimicking the behavior of aggressive HFTs, which according to academic research are the most profitable trader group when it comes to intraday trading. Mean reversion occurs when market makers are adjusting inventory levels back to sustainable levels, which often coincides with the interval VWAP of a period of one-sided order flow. This is due to market makers essentially holding the mirror short position of long buyers during said interval. Here's a quick example of measuring interval VWAP for temporary mean reversion, followed by subsequent intervals of trend continuation. In addition, we can also track price levels or strikes with large option open interest close to expiration for situations where algo gamma hedging competes for liquidity with informed algo order flow and vice versa, resulting in sustained price moves to and from open interest extremes. Now that you have a basic understanding of the concept of urgency driving price formation and are curious enough to learn more about incorporating it in your trading to gain clarity, confidence, and consistency by hacking market microstructure, come by and visit www.CEED.trading.com for more information. To enter the giveaway for full course access to the CEED Accelerator, simply like this video, subscribe to the channel, and follow the link in the description box below to complete your entry. The winners will be drawn on Sunday, June 29th. Good luck and see you in the next video.